Okay. Assalamu alaikum. Can you hear us? Hopefully, yes. Okay, good afternoon and welcome to Ali Bank discussion session for the first half of 2024. This session will be divided into two parts. The first part, we will be presenting a few slides on the bank's performance. And later on, we'll be happy to take your questions and queries. I'm joined today with the management team. In my right hand is Bilal Anwar, who is the Deputy CEO Business Group. Next to him is Habib Al Hamid. He is the Investor Relation Officer. This side is Hana Kharousi, Senior GM, Wholesale Banking, and Mr. Shiram Bala is our CFO. This disclaimer is an administrative matter, and I would request all attendees to take note of it. Okay, so as I said, today we'll be providing a comprehensive overview on the macroeconomic environment and our financial performance and key strategic initiatives as well as we move on. So to start with the macroeconomic overview, guess let's have a quick look on the macroeconomic environment that has shaped our strategies and the outcome for this period. Globally, the economy has experienced moderate growth with world GDP projected to hold steady at around 3% in 2024. The Middle East region is also expected to grow at 2.5%, while Oman GDP is anticipated to increase by around 1.2%. The growth rate for Oman is reflective of the country's prudent fiscal policy aimed at reducing public debts and attracting foreign direct investments. In terms of the physical performance, Oman Medium-Term Physical Plan 2024 has provided a clear path towards greater sustainability. The physical surplus as of June 2024 stood at around 390 million Oman Riyal, which is slightly a decrease from the previous years due to lower oil prices and lower oil production as well. However, despite all these challenges, the government prudent fiscal policy has successfully reduced the debt to GDP ratio to around 35%, which is at quite comfortable level at this range. So the credit agencies responded positively and to these developments, and whether it's SNB, Fitch and Moody's, all of them, they have upgraded Oman rating. And we are expecting the next upgrade to bring Oman credit rating to an investment grade, inshallah. However, Oman continued to make strides in its diversification of efforts in many fronts, including the renewable energy. These initiatives, together with different policies, are crucial to position Oman among the leading countries in sustainable development within the region. Now we'll move to the operating environment. As I said last time, the Omani banking sector has continued to exhibit resilience and steady growth throughout the challenging time that we have witnessed over the last few years. And the total banking asset expanded during this period to reach 43.5 billion, reflecting a compounded annual growth of around 8% since 2022. Also, the customer deposit has seen a substantial growth and stood at 30 billion in June 2024, making a growth of around 11% or 11.7% over the past 2 years. This growth has been particularly robust in the Islamic banking sector, or segment rather, which has continued to attract deposits at accelerated pace. It's important to note that the growth in the deposit is critical and important in supporting the sector liquidity and has provided solid foundation for sustaining lending activities going forward. Looking on the lending side, the total loans and advances reached 31.4 billion in June 2024, with a growth of around 5% since 2022. That's the average growth. This growth is again reflective of the credit expansion within the banking sector in Oman, and mainly attributed to the stable economic conditions supported by, of course, steady oil prices and improved business environment. And we have seen this improvement across various sectors of the economy. And again, it's providing a conducive environment for lending opportunities going forward. The third element is the liquidity, and it remains strong in the banking sector. And that's a result of the significant growth, as I mentioned, in the customer deposit. The increase in deposit has also contributed to an improved position, not only in the sector, but maybe across various aspects of the economy. And also, this will going forward will support the banks in playing its role in providing a credit to various sectors within the economy. The fourth element is the interest rate, and the interest rate environment remain very challenging. The average Omani lending rate increased to 5.6 in June 2023. Also, the overnight interbank borrowing has remained stable at 5.4, and this is closely mirroring basically the CBO repo rate in the market, which is hovering just around the 6%. However, looking ahead and with the anticipated cut in the Fed rate in the September 2024 meeting, we do see the interest rate to soften and start to declining toward the end of 2024, and hopefully we will start the 2025 at a better environment when it comes to the interest rate. The other element is the capitalization, and the capitalization level within the sector remains strong again. The capital adequacy ratio across banks stood at 18% as of the first quarter of 2024. This strong capital position is a cornerstone of the sector's resilience, ensuring that it can withstand economic fluctuations and continue to support the broader economy. The last but not least, it's a topic that we have discussed over the past few sessions, which is the asset quality, and maintaining high asset quality is a priority for the sector. And this again reflected in the non-performing loans ratio, which remains stable despite all the challenges in the past at around 4.5 as of the first quarter of the 2024. This stability in asset quality again underscore the broadened lending practices adopted by the various banks within the sector, and also in line with the central bank guidance in this area. Moving on, And maybe Shiram will take the next part and then the financial performance for the first half of the 2024. Shiram.
Thank you. Thank you, Sai, for setting the background. We'll start with the strategic objectives of Ali Bank. In aligning with our vision, mission, and values of Ali Bank, we have four strategic objectives on the top side of the table. As you see, asset growth. The Ali Bank continues to grow the assets on a prudent risk-based approach, focusing on the sunrise sectors and diversifying the growth in various economic sectors across the Sultanate. On the other objective is deposit diversification. The bank continues to strive to achieve the low cost of funding by improving our retail contribution to the overall deposits. Also, we are striving to diversify our customer base, reduce the concentration, and increase our physical branch presence. The third strategic objective is the enhanced fee income. The bank continues to work on increasing our other operating income as a percentage of total operating income. We do this by focusing on alternative streams of income, including the wealth management, investment banking, bank assurance, increasing the credit card part of it. Operational efficiency is our fourth strategic objective, on which we continue to achieve operational efficiency through all the process efficiency by using RPA, robotic process automation, continue to deliver digital transformation projects on time, enhancing the customer touch points, enhancing efficiency, internal efficiency through automation in various services and our internal processes. So the second part of the slide shows various strategic priorities which the bank is using in order to achieve its strategic objectives, also its long-term vision and mission. Moving on. Ali Bank, just to give an overview of Ali Bank started its commercial banking operations 2007 and rebranded from erstwhile Alliance Housing Bank as Ali Bank, and currently operates through 48 branches, including 24 Islamic branches and 3 state-of-art digital branches. The bank has got a strong institutional shareholding support. Market share of loans as of 30th June 2024 was around 9.5%, and deposits were around close to 9%, 8.7%. The rating for the bank, credit rating for the bank was BB with a stable outlook. During the last 1.5 years, since 2022, the bank grew its assets by 7.8%, similar to the market levels. Deposit grew at 9% CAGR, and loan grew by 8%. During this period, the bank increased its network from 42 branches to 48 branches as of 30th June 2024. The key highlights were the total assets crossed 3.4 billion as of 30th June 2024. The bank also continued to have one of the lowest NPL ratio amongst the peers. During 2024, the bank issued mandatory convertible bonds in lieu of dividends of 4.5 paise per share. It also exercised its call option of 81 capital raised in 2019 on its first call option date, and completed a fresh issuance of around 40 million during this period. The bank also launched new funds and also Sharia compliant investment and financial solutions for its private banking customers. Bank continued to participate in many greenfield loans and financing. It continues to perform its digital transformation journey, achieving many milestones as per the set timelines. The humanization ratio was 94.2%, and female staff were around 40.5% of its total strength. Moving on. The bank continues to have a solid track record of superior and sustainable shareholders' return. It has paid a consistent dividend of over 50% dividend payout ratio. ROE was 11%, and it has a robust business model with efficient operating model with a cost-to-income ratio of 42.5%, 42.4%, while bank continued to invest in digital transformation, people, and its branch network. NPL ratio continues to be 4.1%, one of the lowest among its peers. The bank has a strong institutional shareholding as displayed in the chart below. Also, bank distributed 9 paise per share as dividend for 2023, out of which 4.5 paise was paid as a cash dividend, and the remaining was through mandatory convertible bonds. The MCBs carry a coupon of 6% and it converts through a CET1 at the end of 2 years. Ali Bank's journey since its inception can be divided into 5 phases. The phase 2007 to 13 was the inception and expansion phase, where the erstwhile housing bank was converted to a full-fledged commercial bank and rebranded to Ali Bank. But the Ali Bank started expanding its branch work then on and launched subsequently the brokerage and asset management services. Also in 2013, it's launched its Islamic window with 7 branches during the year. During 2013, the bank built its iconic head office building. The second phase was one of consolidating for growth. During this period, the bank further expanded its branch network to around 20 branches, introduced a lot of services, including mobile banking, e-wallet, wealth management services to its clients, private and premium banking services, and also introduced many products like signature and infinity cards, and launched its graduate development program called HIMAM. And during this period, the bank also raised its first 81 tier capital of 50 million. The next phase was the diversification and strategic growth phase from 2018 to 20, during which the bank launched a full-fledged investment banking, including corporate advisory, asset management, and brokerage services. The bank had a retail business transformation, and the network of branches expanded to 40 branches across the Sultanate. The bank, during this phase, embarked on the digital transformation roadmap and also rebranded its Islamic window to Ali Islamic. During the next phase, which is 2021 to 2022, it was an expansion and transformation phase, where it started its digital transformation journey and launched Ali Express, which is MFKs. It was also the first bank to provide 1:1 IPO financing through mobile app. It launched its Tamkeen crowdfunding. It launched digital branches, and the phase 2 of the iconic head office building was completed during this period with a lot of service centers for our private and corporate customers. Phase 2023, this phase is the bank is moving towards becoming the partner in excellence to all its stakeholders. It continues its digital journey, launching SIP in mobile banking, enhancing its mobile banking services to its retail clients, enhancing its B2B application to corporate customers. It launched e-IPO for Islamic customers. It also crossed a milestone of 1 billion deposits in retail banking and launched corporate credit cards and launch of Sharia compliant wealth management services. The bank's financial track record continues. The total assets grew by 7.8% CAGR since 2022 to reach 3.443 billion as of 30th June 24. It was same in the line with the market. Loans and advances grew by 8% CAGR and ended at 2.805 billion as of 30th June 2024. During this period, the incremental market share of Ali Bank in loans was 14%. Deposit grew by 9% CAGR to reach around 2.612 billion as of 30th June 2024, slightly lower than the market growth. Moving on. Ali Bank has 2 major business segments. The wholesale banking. Ali Bank wholesale banking segment consists of corporate banking and SME, treasury and FI, and the investment banking teams. Corporate banking team provides full array of services through sector-specific teams. which includes the government banking, corporate liability team, and e-channels team. This team strives continuously to focus on various sectors that form part of the Vision 2040. The segment continued to support SMEs through its crowdfunding platform, Tamkeen, both in the conventional and Islamic side. As part of the long-term strategy, the bank continues to strengthen its funding to various ESG projects, some of them being a syndicated term facility lending to a power generation company for a 500 megawatt solar power project. Also, Ali Bank was involved in a financing specialized water utility services and industrial effluent treatment company. The Treasury and FI team provides a comprehensive package of services to corporate, commercial, and government institutions. The FI team acts as a global relationship to all the financial institutions across the world. The investment banking team provides full array of services of corporate advisory, asset management, and brokerage services. It has acted as an issue manager for many IPOs, including one of the biggest IPOs in Sultanate. The asset management division offers a diverse range of investment solutions to its institutional and high net worth clients, including mutual funds and investment advisory services across various subclasses. The brokerage division is a leading player in the Sultanate Muscat Stock Exchange, serving broad range of institutional and retail clients. The wholesale banking assets reached to 2.66 billion as of 30th June 2024 and contributed to around 2/3 of the operating income of the bank at around 32.7 million for the 6 months of 2024. Moving on. Retail banking consists of specialized teams to handle the retail, premium, and private banking clients and provides wealth management services to its high net worth client, and also has Ali Islamic window for handling its Islamic banking customers. The retail team offers its services through 48 branches across the Sultanate, including 24 Islamic branches. The bank started its first MFK in 2022, Ali Express, and as of 30th June, we have 12 MFKs operational. The bank continues to focus on expansion of retail network, including through digital mode, in order to widen its customer base, both under conventional and Islamic banking. The wealth management team provide comprehensive services to its high net worth client and have a dedicated wealth management app for its clients. Retail banking assets reached to 784 million as of 30th June 2024 and contributed to around 1/3 of the operating income of the bank at 17.9 million for 6 months ended 30th June 2024. Moving on, Islamic window, Ali Islamic, since its launch in 2013, offers a unique Sharia compliant product and services through 24 dedicated branch, catering to all customer segments, institutional, corporate, SME, and retail. It was the first Islamic bank in Oman to digitally onboard customers through mobile banking platform, and it also is the first Islamic bank in Oman to offer IPO leverage. Ali Islamic continued to expand its customer base, physical presence, including digital branches with focus on deposit mobilization. Financing of Ali Islamic total to 607 million as of 30th June 2024, and the customer deposits was 661 million from Ali Islamic. Thus, Ali Islamic was fully self-funded. Ali Islamic contributes to about 17% of the overall operating income of the bank. Moving on the financial performance, total assets of Ali Bank grew by 3.8%, around 125 million in the first 6 months to reach 3.443 billion. Net loan grew by 4.1% to reach 2.805 billion in the 6 months. Customer deposits grew by 5.5%, around 136 million in the 6 months period to reach 2.612 billion. Equity grew by 4.4% to reach 544 million as of 30th June. During this first 6 months, operating income increased by 3.2% to reach 50.63 million. In spite of the pressure on the cost of funds, operating expenses increased by 9.7% as the bank continued to invest in digital transformation, people, and the branch network. Profit after tax grew by 1.5% to reach 20.2 million for the first half of 2024. ROE was at 11%, higher from 10.7% as of December 2023. ROA was 1.2%. Overall capital adequacy was at 16.6%, and NPL remained at same level at 4.1%. Moving on, overall operating income continued to grow and reach 50.6 million during the last 1.5 to 3 years period, in spite of the pressure on the cost of fund and deposits. Other operating income as a percentage of total income increased to 27.2%. From 19.2% as of end of 2022. NII spread fell to around 1.7% from 2.2% as of end of 31st December 2022 due to increase in cost of funds and deposits. Cost to income ratio was 42.4% with continued investment in digital transformation, people and branch network. ROE reached to 11% as of 30th June. ROA reached to 1.2% as of 30th June 2024. On the asset side, the loan focus on asset quality remains one of the top priority of bank, and it continues to have the lowest NPLs in the industry. The loan grew by almost CAGR of 8.2% to reach 2.91 billion, but the bank's NPL ratio remained one of the lowest at 4.1%. The total stage-wise exposure of stage 1 assets was around 81.5%. Stage 2 assets were 15% and stage 3 around 3.4% as of 30th June. And the overall coverage ratio was 92.8% as of 30th June 2024. The loans were well balanced and distributed amongst various sectors as displayed in the chart below. Moving on the funding side, the customer deposits grew at 8.9% the last 2.5 years to reach, 1.5 years to reach 2.6 billion. The retail segment share grew to 47% of the total deposit, with corporate contributing 32% and institutional deposit contributing 21% of the total deposits of Valley Bank. CAR ratio was 16.6% and the CET1 ratio was at 10.6%. Net loan to deposit ratio remains stable around 107%. LCR and SFR were well above the regulatory levels at 167 and 113% respectively. The bank has won several accolades for its performance during the years, including some of them in 2024 on excellence in private banking, excellence in corporate banking, excellence in digital transformation, and MENA Corporate Bank of the Year. With this, we come to the end of this presentation.
Now, we can open the floor for the Q&A. Anyone has a question, please, if you can raise your hand, so you can unmute yourself and ask your question or query. Any questions? Yes, Joyce, unmute yourself and please go ahead and ask your question.
Hello, good afternoon, and thank you for the presentation. I have one question on your other operating income during this quarter and this year has been phenomenally well. Could you please explain the reason why the foreign exchange gain and the dividend income has been on the higher side, especially during the second quarter of this year?
Okay. Joyce, thank you. I mean, one of the key focus areas of the bank was to increase the other operating income of the bank. So the bank continues to increase its, various other revenues, including wealth management, bank assurance, trading income, and also various investments on. So this has led to the increase in operating income during the period. So the bank is one of the key strategic priorities has been to increase its other operating income.
It's well diversified, Joyce. It's not coming from one specific, area. It's across the field. It comes from private banking, wealth management, forex and treasury has been a good quarter for us in making, some good money from there. We have some good investments which are also yielding good results, both on the FVTPL side as well as what you call on the dividend side. So we have a good dividend income also in the June quarter. So all that has resulted in a substantially good second quarter, as you rightly pointed out.
So is this a sustainable level of income that we are seeing, especially on the forex and dividend income?
I think this forex income is, I believe, is sustainable because most of it comes from our core corporate customer. We have enhanced our penetration with our large corporate. We've also established SME business significantly, where though the volume may be relatively less, but the margins are probably on the higher side. So we are focusing with our increased branch network. We've been able to attract forex business even from areas which were traditionally not being catered to. So all that has resulted us into a more sustainable and a long-term business model. At least that's what we would like to believe, and we are confident about it. We'll see in the next few quarters how it pans out, but at this point of time, we are pretty confident about it.
All right, fine.
Okay.
Thank you, Joyce.
I see Vishan Bala. Can you unmute yourself and go ahead?
Hello, am I audible?
Yes.
Sure.
Hi, good afternoon. This is Vishan Bala from Vision Capital. Thank you for the presentation. Just a couple of queries. Just want to tie in your CASA and your NIMs. We've seen CASA sort of in the 45% range, 47% range for the bank. What's the strategy to increase that more towards the sector average? And if I look at your spread, we've seen a sort of drastic drop. We've seen that across the sector. We've seen that especially with Ahli Bank over the last 3 quarters. So if you could just, once interest rates drop, how do you see that sort of panning out? Could you just give your comments on that?
Yes, thank you, Vishan. Yes, you're absolutely right, and that's our biggest challenge, and that keeps us awake in the night. If you ask me what keeps us awake in the night, so the drop or in the NIM or the significant increase in the interest cost, which has not been able to pass on to the customers, is a significant what you call concern. But as Saeed initially mentioned, that with the expected benign or softening interest rate scenario in the next few quarters and months and years, we believe that what has been a bit painful for us will start to work on our side, and we start gaining a bit good traction when it comes to the reduction of the cost of fund. The CASA, as you said, is good at 45, 47, but we appreciate a lot of it. CASA is also having some interest rates component in it in terms of call account, and those government institutions are asking for their, on big corporate customers right now ask for their pound of flesh in the interest rate when we know the market's at a very high rate. So, but as we know, as we believe, as we move forward in Q3 and Q4 and in the Q1 and Q2, we should get a significant, some sort of kickback in terms of the interest rate reduction, which will subsequently improve our NIM.
Right. Thanks for that. Now, on the loan book side, you have the highest ratio of corporate to retail at 73-27 compared to the sector at 65-35. So when these interest rate cuts happen, you would also see a repricing on the corporate book side. So that would actually counter some of this cost of funding pressure that you face. So if you could just give your comments on that.
Absolutely right. That will happen. No questions about it. But as per our own calculation and assessment done by the CFO and our team, our asset liability position, the gain which we should make from the reduction in the cost of fund should be much more than what we will have reduction in the corporate book. So because as you know, corporate book also, we have not been able to reprice because some transaction which was at 6% 2 years back, though our cost of fund has gone by 2%, we've not been able to reach at 8%. I mean, if you look at it, theoretically, 6% should become 8%. So it has not become 8, it has become 7. So 7 will not go to 5, it will go to 6 if it what you call the interest reduction starts happening. So you're right, there will be always this, a play between the reduction in the corporate interest rate versus the reduction in the deposit rate. And that's where the management and the people within the system and our employees come into play to see that, to ensure that we get the right balance.
Noted. And my last query is, on the capital adequacy side, is that a comfortable level where you stand at 11% for CET1 and overall capital adequacy? What are your thoughts on the same?
Okay. So, see, we have this year we have started dividend distribution through 50% of the dividend through the MCBs. So this in turn will protect. This will flow into the CET1 after 2 years. So we will probably, adopt the same methodology for few years till we reach a comfortable level. So that we don't go back again to the shareholders for further raising share capital.
Having said that, shareholders are very what you call, institutional shareholders. If the business and situation warrants and there is a business case where we can give them a decent return on equity, we are pretty confident that we'll be able to raise capital from the market if it so warrants.
Noted. Now, on the cost of risk side, we've seen net provisions come down. We've seen that across the sector, but especially for Ahli Bank. How do you see the credit cycle panning out in terms of the sort of discussions you're having with your top clients, the overall book, sort of the systemic risk and specific to Ahli Bank? How do you see that panning out?
Yes, you're right. The last 6 months across the industry, the cost of risk has gone down. I would believe that a lot of it has, we have moved a lot from the 2020 and 2021st quarter, the COVID, when the uncertainty were there, restructuring were there, and a lot of cash flow uncertainties were there. We have moved on quite significantly from there. Situation is, of course, not as grim or as, poor as it was 3 years back. But still, some headwinds are continuing to go there. Especially the interest rate scenario in the last 1.5, 2 years haven't helped that cause. But the situation is, of course, much better than it was 2 years back. It will continue to have a much higher cost of risk compared to pre-2020 era. But probably it will not touch the same what it was during 2021-22, which was a more difficult and tumultuous time for the industry.
Noted. Now, on the provision coverage ratio, I believe Ahli Bank is at 94%. Is that correct?
93%, yeah.
Right. So what would be a target provision coverage ratio? Would you look at building it up to 100% by being more prudent, or you think it's at a comfortable level for yourselves?
See, there's no target ratio because it all depends upon what type of NPAs we are having and what collaterals we are having, what securities we are having under those NPAs. If we end up having NPAs where the chance of recovery is pretty low, you will see a much larger coverage ratio. But if we are sitting on high level of collateral and securities, and we believe that there's and we and our auditors and central bank, because as you know, all this is audited and by auditors, central bank, and all the processes. So if you believe we are sitting on a good security, good type of mitigants in terms of collaterals, then probably it will be on a lower side. So every quarter, depending upon what our NPA position is and what levels we are in, it will keep moving.
Okay, point well noted. And the last point is, you mentioned about being able to mobilize money from the market in terms of, a rights issue or a perpetual bond, depending on the ROE. So we witnessed that, the bank has done well to grow its bottom line over the years. But if I look at the ROE, and I'm talking about the adjusted ROE after paying a perpetual interest because that's an explicit cost, it's still among the lower, sort of lower ranking in the sector. So sort of how do you see that improving with time? What are the aspirations to reach a double-digit ROE over the let's say next 2 to 3 years?
Yeah, yes, aspiration. And I think somewhere in the middle, if I'm not wrong, in terms of adjusted ROE, what you are saying.
We're just in the middle.
We're just in the middle. We are not the lowest, but having said that, we do agree that we need to improve and we should improve. And all our efforts are there to improve it. And as we move on and make more profits every year, I'm sure this ROE also will move on and become a bit better.
And any sort of target number you have in mind? I understand it's not easy. I'm not asking for a guidance, but do you think a double digit, currently there are 2 players, almost 3 that meet a double digit ROE. Do you think that's sort of realistic over the next 2 to 3 years?
Again, I will not give any specific number, but as I said, all our endeavor is that we improve our ROE so that next time when we come to you as investors and shareholders, we are in a better shape. So we will continue to put all our efforts. But as you said, the market interest rates, for example, if the interest rates were not moving in the way it moved and our NIM would not have come down to 1.7, you would have seen a much significantly improved ROE. So these are things which depends upon year to year what market dynamics we are navigating. If the market is in our favor, if things are much more controlled, of course we will what you call increase our ROE. But if we get another headwind, we will be still challenging and we'll be trying to work it out.
All right, noted. That's it from my side, gentlemen. Thank you so much and wish you all the best.
Thank you, Vishen. Any other questions? Okay, I don't see any raised hands. We'll give another 5 seconds if you want someone want to ask any questions.
Okay. All right then. Thank you very much for attending this session. Inshallah, we'll see you in 4 years.
Yes, Vishen.
Sorry, one last query from my side. The dividend we saw, announced this year was a combination of an upfront cash component as well as, a sort of longer payment, longer duration bond, right?
It's 2 years.
2 years. Bond.
Yeah. Now, is that a policy the bank would adopt going forward as well, or was this sort of a one time and next time you would sort of try and stick to this cash dividend? Just want to understand the policy or the strategy over there.
It is a short to mid-term policy. As mentioned by Shiram, and we are slightly below the market average when it comes to the CET. So this is a sustainable way of enhancing our capital base, and this is a short term, as I said, to mid-term program until we are adequately, I would say, capitalized when it's come to the CET level. So you would most likely see this year as well. If that's what.
Yes, that's what
subject to board approval, subject to AGM approval. Let me qualify. This is just a statement.
Absolutely. No, I'm fully with you on that. Absolutely fine. Thank you. Thank you for answering my queries. Thank you so much.
Okay, thank you.
Thank you, Vishen.
Thank you, Vishen. So we are coming to the end of this session.
Okay, thank you.
Thank you very much. See you in the next session.
Thank you, everybody.